Okay, guys, so we are your data-focused coaching company, Robinson Lloyd Resiliency Group. I'm Robinson, he's Lloyd, and we gift our third Saturdays to help our communities build their resiliency through financial expertise, social emotional learning. And we have the most power in an hour. P for practical, O for observational, W for wisdom, E for energy, and R for we keep it real. We keep it 150. Okay, and so Sean is going to introduce our presenter. We're very, very happy to have Laquan Marshall from the Johnstown Capital Group. They are making waves, they're doing great things. We're happy to have them, and Sean is going to introduce them to you in 3, 2, 1.
All right, good morning, everybody. Again, just for some context, we had Laquan and Satiir on a couple months ago, but they had shared an hour with Matthew from Fortis Lux, and both of them had so much information that we kind of felt a little cheated. So we asked both of them to come back, and Laquan is here today. He's from, as Tonya mentioned, he's from Johnstown Capital. They're in Johnstown, Pennsylvania, and it's a full-service real estate development company. They do ground-up construction. They do maintenance. They sell the real estate. They have a deal also with authority in Johnstown, where they're using different tax incentives, et cetera, to make it happen. And their wealth of knowledge is, I mean, I can't explain it, so that's why we asked him to come back. So we're going to get started. Oh, let me tell you also, 3 of them are from Roselle, 2 exits down the Parkway. And then one of them is from South Orange, right next door here. And that's another beautiful part about the information that they give us, because we grew up with them, right? And they're young entrepreneurs. They've been doing this for a while, and I'm here to learn as well. All right, so we're going to get started, but before we do that, let's do a little icebreaker, right?
Unmute, guys. You got to unmute for this one.
And so I know it's kind of right. It's a little generic, but I think it's very appropriate, especially for what's going on now. We wanted to discuss or share what we're grateful for right now, right? And if you're super shy, you can type it in the chat. But
we don't have shy people in this place. We don't have no shy people.
I'll take 5 or 10 seconds and I'll say mine out loud and give people a chance.
Okay.
All right. Go. Oh, you want me to go right now? All right. Well, I've definitely I'm grateful that we have a comfortable place. And it's pretty generic as well, but we have a comfortable place to live. Our family's healthy. We're together. We're working together as well. We have couple opportunities coming up. A lot of the daily work that we're putting in is particularly my wife Tonya, what she's been doing with this business last few years. Every day going into the schools, it's really starting to pay off and multiply, and I'm very grateful for
that. Toastmaster Alton, you're up next. Toastmaster Alton, what are you grateful for?
Good morning, everyone. I'm grateful for my health. I'm grateful for the opportunities that have been presenting themselves even in this pandemic. I'm grateful that I'm associated with strong people with great character, and I'm grateful every day. As long as I can get on my bicycle and ride, I'm happy.
No, that's right.
All right, we want to clap. Let's get some good energy going in here, guys. Let's see, Mobs, what are you grateful for?
Did you say Mobs?
Yes, ma'am.
So Mobs is grateful just to be alive, really, to be able to, like the previous speaker, to be able to get up and get out and do what your body's supposed to do, which is live to its fullest. Even in spite of all that's going on, to be able to continue to, to be happy, to be at peace.
Beautiful. Thank you, Maz. Raymond's in the house. Raymond, what are you grateful for?
I'm grateful for the opportunity to grow every day, gain perspective, and I just started a new position at a school, so I'm grateful for that opportunity.
Congratulations. You deserve it. You're perfect for that.
Yes. What's the position? Tell us.
I'm a dean of students, so I'm working more with communicating with kids, helping them work through things that they're doing behaviorally, and kind of just navigate through the experiences every day. So I'm out of the class.
Awesome. Yes. Awesome, Ray. Way to go.
Thank you.
Way to go. Congrats. All right, Kathleen. Kathleen, Mama Kathleen, what are you grateful for? She can hear us?
I'm grateful to see all of you on your end, warmly clothed for the weather.
Yes.
And on my end, it's dark and rainy and windy. So I'm feeling the cool.
Nice. Daddy from St. Lucia, Anthony, what are you grateful for?
I'm very grateful for life. Every day I get a chance to live, I am grateful. And I thank God every day for you guys. Just be seeing you guys, and I know you guys are going up and up and up and up, and I'm very happy for that. God bless you all.
Thank you so much, Dad. Heather's in the house. We see you.
Good morning.
Good morning.
I am grateful to be alive. I'm grateful for health, happiness, my family. I'm grateful for survival and for the fact that things always work out for me, and the universe and God is always providing and taking care of me, and I'm grateful.
Right.
Yes. You bet. Joseph, happy to see you. What are you grateful for? Hi, Joe.
Good morning. Good morning. How you doing?
Good. How you doing?
I'm great. I'm just grateful to be alive, and I'm just thankful for the things that I have in my life.
Beautiful, beautiful. All right, guys, we're gonna wrap this up in 1 minute so that Laquan can get his awesome information going. We just want to ask Satiir and Laquan to tell us what they are grateful for. And everybody else, please feel free to pop it in the chat. We still want to know what you're grateful for, okay? Satiir, you're up.
I'm grateful to, have a healthy baby boy on the way.
Yes.
Beautiful.
I'm grateful for being able to wake up. I'm grateful for the pandemic has turned my barbershop into a need-based business. So I'm just, I'm grateful to have, wonderful partners. I'm grateful to have a family that's still healthy and breathing and sticking together throughout this process. So those are things I'm grateful for.
Yes, way to go, Satiir. Congratulations on your baby boy. Can't wait to see him. Send us pics. Laquan, you're up. You're going to take this all the way.
Yeah. Okay. So, good morning, everybody. I'm grateful for God's grace, right?
Yes.
I'm grateful that He has delivered my beautiful baby girl. She's on her way to be 6 months. I'm grateful that He's blessed me with a beautiful black queen, my wife.
I know that's right.
I'm grateful that He's keeps His abundance around my family and ourselves, and health, prosperity, right, love, and togetherness. I'm grateful that He's guided our steps and brought us down this journey to real estate, and being able to impact communities and impact people, and do events like this where we can share information and continue to push the culture forward. So I'm grateful for everything, every opportunity, every pitfall, every learning lesson.
Michael, how do I turn up the volume?
Auntie.
One second.
Hey, Auntie. Sorry,
Finish the Laquan. 1 second.
No, that was it.
Okay. Hello.
Okay, so.
Okay.
All right.
Unmuted. You want to share? We can start.
Yeah, we can start. No, Laquan has the floor. Sorry, Laquan.
Thank you. So I'll share my screen here. Just everyone, let me know if you can see.
We see it.
Okay. Awesome. So I'd like to thank you all for spending your Sunday morning to learn more about real estate and kind of growing your wealth and who we are and what it is that we do and why we do some of the things that we do. So I am Laquan Marshall. I am CEO and head of development for Johnstown Capital. I have my partner Satiir Stevenson on the line. He's our chief investment officer. He spearheads our acquisitions. Our partner Dwight Boston couldn't make it. He is our chief operating officer and head of asset management. And we live by the quote above, right? We feel that true happiness, or we know that true happiness is found in the servitude of others. And we pride ourselves on the communities that we're able to serve and develop within, and then the investors that believe that we can be the catalyst for change. And in this presentation, we'll talk about two major things, right? So I'll walk you through almost kind of like a real estate investing kind of 101 and give you some backstories on investment opportunity, investor profiles, and, you know, some quick performers on different types of active investment opportunities. And then I'll walk you through what it is that we're doing, which is more for investors as a passive investment opportunity. And then I'll walk you through the research that we've done and through the lens of a developer. And then we can open it up for questions and answers. You can access it more about some of the information. We can backtrack the slides and also about investor opportunities. So let's jump right in. There are typically, generally, two types of investors, right? So they're active investors and they're passive investors, right? And there are three different types of commodities that you have to determine what best profile suits you, right? So you have time, experience, and money, right? So if you have a lot more money, you get credit, but you don't have a lot of time or experience, for an example, that would be a doctor or a lawyer or a high-level professional, and you don't have the time to actively be involved in real estate, you know, it may better suit you to invest capital, potentially be a sponsor in other investors and investment opportunities. But if you do have a little bit of time, a little bit of know-how, and some cash, maybe the active investment profile suits you best. So quick examples are if you're developing a rental portfolio, and it's not as definitive as black and white, it's more of a spectrum in how you identify whether you're an active or passive investor, right? So the most active investors are developers, fix and flippers, and then it scales back into maybe you are developing a rental portfolio, all the way down to just directly investing into maybe an online REIT or a traditional REIT, right? So, you know, an example of that could be a rental property, a fix and flip. That's an example of an investment, an active investment opportunity. And the time requirement is almost that of a full-time job, right? There's project management that has to be had through the construction process, through the selling process, through the purchasing process. You would need to source deals. You would need to do heavy due diligence and then property management as well in that role. And then in the passive role, you can invest in REITs, syndication deals, you know, help sponsor smaller development opportunities. And that's more of a part-time time requirement up front, and then very little and no time involvement besides kind of verifications on the back end. So you wouldn't need to source deals. You wouldn't need to manage assets, project manage, but you would need to, in all investment opportunities, participate in that due diligence period just to verify it's a viable opportunity. And this speaks more towards the spectrum that I was talking about a little bit earlier. So from left to right on your screen, it's more or most active to more or most passive, and then the returns are high to low, right? So fix and flips are some of the most profitable forms: development, land flipping, wholesaling, traditional rentals, right? And then it moves down to REITs where your returns will be a little bit lower. So you can have anywhere from 28, 165% returns when you're looking at fix and flips, all the way down to maybe 8% 10%, 12% return on your cash in traditional REITs, right? And this is an example of an evaluation for a fix and flip, right? And I'll direct your attention to the area that's highlighted in green. You know, you're looking at a desirable profit margin of about 15%, right? So you're making about $24,000 on that flip. It takes you about 4 months, but you know, I want to give you kind of a scope of how to enter in the flipping in a very, very basic or service level. And then, you know, I'd encourage, if this is an avenue that you feel, you know, kind of suits your investor profile best, doing more due diligence yourself. And then we'll have our contact information at the end. You can feel free to, you know, contact us directly and get more information about this process. So you should always try to reverse engineer all your evaluation as it relates to all investment opportunities, but specifically flips, right? So there's a 70% litmus test that you want to make sure that you use when evaluating a flip opportunity. So you want to make sure that your acquisition, construction, and fees are no more than 70% of the total loan to value, which is determined by the after repair value. So that's, you'll see some terminologies or abbreviations, LTV and ARV, used in the presentation, and then used around the industry as a whole, right? So LTV is loan to value, right? And then ARV is after repair value, right? So for numbers' sake, I'll break it down at a very simple level. So in order to determine your after repair value, it's typically based on the comparables in the market, right? So let's say if you are looking at a 3-bedroom, 2-bathroom home that you would like to renovate, right? That's came on the market, you think it's a pretty good deal, right? You're looking at, you know, comps sold, so homes sold in that area in the last up to 180 days with the same bedroom or similar bedroom, bathroom, and square footage. So for example, you're looking at a 3-bedroom, 2-bathroom, 1,500 square foot single family home. You want to make sure that you have a good understanding of what 3-bedroom, 2-bathroom, single family, 15 square foot single family homes are selling for in a maximum 1 mile radius of the property where it's located, right? So let's say those homes at 3-bedroom, 2-bathroom, 1,500 square feet in a 1 mile radius have sold for $100,000. You typically want to be all in that investment 70%, so $70,000. And that's a metric that's followed by the banks as well. You know, they won't, a bank or hard money lender won't lend you over 70 to 75% loan to value, depending on whether it's a soft or hard market, right? And the average days on market, right? So they'll take a little bit more risk in a more secure market like a Manhattan or Los Angeles. But, you know, areas like in North New Jersey, Jersey City, maybe a bit of a softer market, so they'll want to have less stake, right? So let's say you want to make sure that you can purchase and renovate this property for no more than $70,000, so you're reverse engineering it, right? So the very next step is evaluating how much construction and how long the construction will take, right? So for conversation's sake, let's say it'll take you 90 days to renovate this property at, you know, $45,000, right? That would give you the room of about $25,000 to purchase this property, right? And no more. So you would purchase it for $25,000, renovate it for $45,000, which would put you all in at $70,000, and then you can sell it at 30% profit margin, right? So you potentially make $30,000 on that deal, and it'll be closer to $20,000, $25,000 after fees, right? Because you have to evaluate seller concessions, you have to evaluate closing costs and realtor fees, etc. Right? So, you know, when evaluating fix and flips, the construction is very important. Having a good pulse on the market is very important. right? And understanding the numbers are very crucial. And if you were interested in fix and flipping, you know, at the end, we'll have our contact information, and I'm sure, you know, the contact information will be shared through other channels. Feel free to just access and we can walk through properties that you're evaluating, because we're here to kind of pay it forward and make sure that people that are interested in the real estate industry are doing it correctly. The next opportunity, and from most active to least active, is wholesaling, right? So wholesaling is relatively simple. And, you know, if you're not interested in wholesaling, right, please beware of, I know you'll see ads and things on social media saying, hey, you want to get into real estate, you want to build wealth with bad credit and no money down. You know, that's really not a wealth generation tool. That's a cash generation tool. And they're really pushing wholesaling, and you kind of filtering deals through them. So wholesaling is a really good way to break into the industry. You know, it teaches you the most valuable skill set, which is how to evaluate deals. And then it also gets your cash flow and cash reserves up in order for you to graduate into fix and flips, buy and hold, and ultimately development. So the process of wholesaling is relatively simple. There is a motivated seller that's typically not on the market, right? So you're driving through your neighborhood and you notice a house on the corner has a lot of deferred maintenance, right? You see windows broken, you see, you know, all types of grass and vegetation growing, a lot of dilapidation at that specific property, right? And maybe it's not being optimized or taken, you know, well taken care of. That might be an indicator for a motivated seller. Maybe that's a rental property they can't rent for whatever reason. Maybe they can't afford to do the maintenance. Maybe it's a property that was inherited, right? There are a ton of different factors or qualifiers that determine a motivated seller, right? So your job as a wholesaler would be to start to identify motivated sellers and get properties under contract, right? So you would talk to, you know, that the owner at the end of the house at the end of your block, and they may say, hey, you know, we did have it as a rental property. I inherited when my father passed. You know, I'm not really that interested in real estate. I really don't understand it. I don't have the money to put into renovations. The list can go on, right? You would then get that property under contract. So when you have a property under contract, you now have equitable interest in that property. And essentially what that means is that if that property, the owner is comfortable with you buying it off the market, maybe they don't want to pay the agent fees, maybe they don't want to do the cleaning to get it on the market. They agree to sell you that property at $250,000. But you know that developers may be comfortable purchasing that property at $260,000, $275,000, $300,000, right? You would then get a contract on that property and then assign your right to purchase the property at a $10,000, $20,000, $30,000 markup, right? So, you know, it's really called, and I'm doing air quotes, contract flipping. So you get a contract on the property at a prime rate, then you go ahead and sell the contract or sell the right to that property in exchange for your equitable interest. So say you get it under contract $250,000, you assign that contract for $260,000. The end user is comfortable paying that price because they have experience in construction and development, and you make $10,000 on that transaction. That's a very kind of low barrier of entry into the kind of real estate industry. You know, it just requires you to have the time and experience and understanding deals, understanding how to evaluate properties properly, and developing a network of buyers, right? Of people who do development, people who buy and hold, do fix and flips, etc. And then next, you'll have buy and holds, right? So that's when you buy single families, multifamily properties, and you invest in them through creative or traditional financing, and you purchase the property and then you hold it and rent that property out. So, just as a very surface level, and again, I'll note, if this is an avenue that interests you best, feel free to contact us. We're here to answer questions. We're here to walk you through and help you through financial models, performance, etc. You evaluate the property by the purchase price. So let's say you're purchasing a 4-family home through a traditional FHA mortgage, which is typically anywhere from 3.5% to 5% down, right? And you purchase that property at $325,000. You put all into that property about $17,000. So $12,000 down. That's maybe $5,000 in ripping up some carpets, putting some new flooring down, putting some paint on the wall, right? Just sprucing up the property. You have an all-in expense of $17,000, right? And this property generates about $3,600 of monthly rental revenue, right? And then you have to consider that you're paying the mortgage, you're paying typically water, sewer, trash on the property. You're putting money away for capital expenditures. Capital expenditures are roof repairs, boiler repairs, furnace repairs, plumbing, electrical, anything that essentially makes the house function. And then you're putting 5% away for maintenance, right? So that's, you have a tenant move out, you have some turnover, maybe there's some damage to the property, there's some cleaning that needs to be done, maybe a toilet is clogged, etc., right? You're putting all of these, the insurances on the property tax, which typically is tied into your mortgage. Maybe you don't want to manage the property, you hire a property manager at anywhere from 5 to 7%, depending on the market you're in. You're putting all of these things away, and that's deducting from your monthly or your gross scheduled income monthly. So you rack up a bill of about $2,759 a month, which would leave you with about $841 in cash flow, right? So that's not a bad deal, right? You put 17 grand down, you own the asset, you're generating $841 a month in rental cash flow. You're getting a 17.86% cash on cash return on your money. And that's generally right for people who don't have the time to do the fix and flip. They're still interested in real estate. There are 3 litmus tests that I use to evaluate whether, when I consider purchasing a rental property, I try to hit 3 different metrics, right? I try to hit cash flow, appreciation, and instant equity, right? So when I purchase the house, I'd like to purchase properties a bit under market value, right? So let's say the home appraises for $350,000. I like to purchase properties like that anywhere from 10 to 15% under market value. So if the property is worth $350,000, purchasing it at $325,000 would be right in my wheelhouse, because I would have a cushion of about $25,000 of equity automatically built into that property. And then I can then take a home equity line of credit, so a HELOC, or refinance the property and pull some of that equity out so that I can use that money to either purchase more property, do renovations, not out of my pocket, right? It just leaves a bit of flexibility. If I need to exit that investment opportunity, I can then fire sell that property and sell it a little bit under what it's worth, and still become whole, right? So, those are the litmus. The cash flow is very important to me, right? And there's a certain, I like to see 20 to 25%, cash on cash returns, because, things, it's Murphy's Law, right? If things go wrong, they will, right? So boilers break, damage to the property happens, right? You know, and I'll tell you a quick horror story. I'm in the Mid-Atlantic Real Estate Investors Association, and there's landlords there who've had some pretty tough tenants, right? So they were missing payments. They had to go through the eviction process, which can be expensive depending on which state you're in. I know it's very expensive in New York, very expensive and time consuming in New Jersey. You know, that tenant, you know, stayed in the property for months, and then they poured, you know, cement down the drains, right? And, you know, yeah, so depending on the neighborhood, they poured cement down the drains, and then that landlord had to replace the plumbing system because of a disgruntled tenant, right? So, you know, you want to make sure that you leave yourself certain cushions, certain buffers, and when you're evaluating rental portfolios. So I'd like to see 20 to 25% cash on cash returns. I'd like to see 10 to 15% equity built into the property. And then, you know, I look to invest into areas that are on the current upswing. So investing in Jersey City 2 years ago, investing in Newark now, right? Investing in places like Harlem 10, 15 years ago, right? You look for market indicators that, you know, you look for population growth, job growth, etc. So that tells you that a market is on trend to becoming thriving. You come in early enough where you can do either forced appreciation, so that's adding square footage through construction. You looked at organic appreciation, things like Whole Foods coming into the market, Starbucks coming into the market, those types of indicators, where your property you purchase for $325,000 now, it'll be worth $500,000 in 10 years, right? And then you can pull some equity out and use that equity to purchase other properties, right? So again, I you know, the line of communication is relatively open. We'd love to talk more about these types of active investment opportunities and help you kind of chart your path down any one of these courses. There are an immense amount of passive opportunities. Say if you're a high net worth individual, or you have really good credit, or you have capital saved up, those are options that you can use in order to invest passively, right? So maybe there's someone in your network that you trust, you know their character, you know their credibility, you know, and they need a partner to come in. Maybe they have the cash, maybe they have the know-how, but maybe they've over leveraged personally, right? So maybe they have 6 or 7 properties on their personal credit, and maybe they can't use their personal credit to purchase other assets. Maybe you can come in as a sponsor through that partnership and say, hey, you know, I make a pretty good income, I have cash reserves, you know, I can come in and guarantor this property, and I can have a 30 or 20% entitlement to the cash flow, right? That's an option. You know, and I only recommend options like that if you have a very strong relationship, they're a very credible person, and they've had success in the past. You can put your capital with fix and flippers, buy and hold investors. You know, you can invest in traditional REITs, you can invest in funds, you can invest in development companies directly. But there's an immense amount of ways to actively pursue real estate investing, and then also passively pursuing real estate investment. So, you know, I want to talk to you a little bit more about, you know, who it is we are, what we're doing, and then also take you through how we've evaluated this investment opportunity through a development lens, because maybe someone on the call has an aspiration to pursue real estate development and, you know, want to know what to look for when doing so. So we're Johnstown Capital Partners. The slide in the beginning of myself and my 2 partners is the executive team. We've developed a board of advisors who have an immense amount of experience in real estate development. We have Reginald Canal. He's actually with Fortis Lux, which is how we made the initial connection through Matt and the Fortis Lux team. They actually are our wealth advisors. Reginald Canal has an immense amount of experience in investment banker. He's been an investment banker with HSBC, He is currently a wealth advisor at Fortis Lux now. He sits on our board in the fundraising and strategic partnerships perspective. He has access to a lot of individuals that is filling some gaps for us. He actually connected us to Ted Baker, who is the director for community and economics for the state of Pennsylvania, and he sits on Governor Wolf's board. And through his network, he was able to connect us so that we can start to procure public capital and start to cut through a lot of red tape as we begin our development process. We have Veronica Sutton, who has been a champion for affordable housing with the state of New Jersey. So she actually sat as president for the Urban League for the New Jersey City chapter. She actually is an award-winning. She won 2 national and 2 state development awards. She has over 30 years of development experience. She's been an advocate for affordable housing. She's championed a lot of legislation that's happened in the state of New Jersey for blight elimination in communities like Jersey City, Newark, right? She's also currently consulting and working on a $22 million, 46-unit new construction luxury condominium complex in Jersey City, which is community paw. So she brings an immense amount of development experience as an advisor. She brings an immense amount of experience as it relates to affordable housing, because we consider ourselves conscious urban developers. So it does, when it comes to price tax, it's about the financials, but it's also about social impact as well. We also have Roosevelt Benem. He is an attorney by trade. He is a partner at Murphy's LLP. He specifically represents a lot of large developers in Newark, New Jersey. He is currently part of building a theater actually downtown Newark now. He has an immense amount of experience as it relates to government affairs when it comes to development. So organizing and orchestrating council, a little bit of lobbying, right? He's actually really good friends with Governor Murphy. He helps a lot of politicians get elected. You know, so he has a very impressive network, an immense amount of experience and knowledge as it relates to the legal perspective and government relation perspective in real estate development. We also have Courtney Sloan, who's an interior designer. She actually is an award-winning developer as well. She worked on the Urban League's headquarters with Ms. Sutton, who they won 2 state and 2 national awards for that project. She has a immense amount of development experience. She has other design awards that she's won nationally and internationally. A few of her projects, keynote projects that she worked on, she's actually helped design a theme park for Disney. She's designed BET's headquarters. She's designed for Sony. She's designed for P. Diddy. She's designed for Queen Latifah. She's designed for Biggs Burke, who's a part of the original kind of Rockefeller Records executive team. So she has an immense amount of experience as it relates to design. And then we also have Andrew Coombs, who has worked for KPMG. He's worked for Lloyd, and he currently owns his own accounting firm now. And he comes and brings an immense amount of experience as it relates to finance, to our projects, and developing capital stacks, soliciting support from institutional lenders and such. So we're very excited to have developed such an impressive team around us to kind of fill in the gaps as it relates to development. And I'd like to tell you a little bit more about the backstory of Johnstown. So about 3.5 years ago, we entered the market. We purchased 6 units in the city of Johnstown. So we initially purchased through a turnkey provider who, purchased, right? And that's another opportunity, a passive opportunity to purchase through turnkey providers, right? They purchase, renovate, and then rent the properties and then sell them to investors that are looking for passive investment opportunities. We purchased through the turnkey provider. We had a bit of extra capital that we wanted to park in some assets. We got connected through the Mid-Atlantic Real Estate Investors Association, one of our chapter leaders. Have worked with them in the past. We parked the capital in 6 units, about 150,000. And, you know, we experienced in the first year a lot of red flags, right? So there was pretty poor communication. You know, there's a lot of deferred maintenance on a lot of the properties. Those red flags forced us to dive a bit deeper. We initially bought the assets from a capitalization perspective, right? So we purchased 6 units. We purchased it based on the net operating income. We closed on those units in cash. You know, as we started to do a bit more digging, we realized that we paid about 2.5 times more than we should have for the properties if we would have entered the market for ourselves. So we found ourselves in what most investors would be a very tumultuous, chaotic investment opportunity. But we scratched our head because we were still making 8% returns on our money, right? So we're like, hey, you know, we paid 2.5 times more. We're hovering at 50% occupancy. We have subpar management, a lot of deferred maintenance, right? You know, how is it that we can produce these types of returns, right? You know, that was our initial question. So myself, Satiir, our executive team, we started to do a lot of digging. We connected with Richard Hudak, which is the landlord association, the president of the landlord association. You know, we connected with the executive director for the redevelopment authority, community and economic development director, to get a better understanding of what was happening in the market. And, you know, we learned that there were a lot of market indicators that were pushing very aggressive rental rates in the market and very low property value, right? So, you know, we looked at Johnstown historically, right? So the city actually historically has been a steel and coal town, right? So the economy was propped up by those two industries. And in 1992, they left the market and it dilapidated the economy. And there was a lot of migration outside of the city, right? So what you look for as a developer, you look for job growth, you look for population growth. Historically, we saw a lot of population decline and job decline over the last 2 to 3 decades. And that was due to, you know, the major economic pillar leaving in 1992. And then also geographically, Johnstown sits in the Valley of 4 Mountains. And, you know, it was a major flood zone, and there was a flood that caused over $300 million in property damage in 1977. So it created this, you know, vortex of blight and dilapidation. And in short, in the last 3 to 5 years, what we've noticed a major resurgence in job growth and job diversity, right? Or industry diversity. And we didn't see the population growth follow. So a quick, you know, highlight reel, and we'll get to the close so that we can open it up for questions and answers. Intuit, so that's a fintech company that you know, owns QuickBooks and TurboTax, has opened a prosperity hub in the city of Johnstown. They've actually brought, since 2017, 350 jobs to the market. There are 3 big regional banks who all have headquarters downtown. There's Conemaugh Medical Group, who's a huge regional hospital group in the state of Pennsylvania. They actually have 2 hospital campuses in the city of Johnstown, one downtown and one in Roxbury. They have, you know, in the state of Pennsylvania, there's been the trend of medicinal marijuana usage, and it's trending towards the recreational use of marijuana. So in the state of Pennsylvania, most cities, you know, accumulated 2 vouchers, and there was only 2 other cities that accumulated 2 vouchers, which is Philadelphia and Pittsburgh. They both received 2 vouchers to open dispensaries downtown. Johnstown actually accumulated 3 vouchers, 2 dispensaries, and then 1 grow house that's all opened up downtown in the city of Johnstown. We have a telehealth suite company that's coming to the market. The city has actually procured a $1.95 million grant to redevelop their old business college. to bring the telehealth suite company to the city of Johnstown. So all in all, in the last 3 to 5 years, we've seen over 2,000 jobs hit the market that's never been there before, right? And this graph that you're looking at is the core urban fabric of the downtown Johnstown area, and some of the smaller businesses that have opened in the last 3 years. So you have a bunch of food and beverage and hospitality businesses, restaurants, bars, breweries, right, lounges, bakeries, etc., that have opened up downtown. And that's shown us a lot of economic growth, right? And typically what happens is you see economic growth and you see residential growth follow, but we didn't see that in the city of Johnstown because, people have been opting to commute. So there's 47,000 people that work in the city of Johnstown. Over 60% of that working population commutes outside the city to live, right? So you see those numbers in Manhattan, you see those numbers in DC because they're densely populated and they're very expensive. But actually in the city of Johnstown, it's more affordable to live in the city than the surrounding communities. And it's more convenient to live near where you work, right? But we noticed that the average age of homes and the demand for those particular areas are very, there's a direct correlation. So in the city of Johnstown, houses are built 1918, 1921. 48% of those homes are built prior to 1940. And then you look at the surrounding communities, 40% of those homes are built post 1970, right? So you see major disparities in the age of the homes, which is a direct correlation between the quality of inventory, residential inventory. So you have drop ceilings like you see in doctor's offices, carpet in the kitchen and bathrooms, very dated appliances, vinyl paneling everywhere. You see, these professionals, right, these doctors, these lawyers, these fintech professionals, they want to live at a certain, quality or standard that the city doesn't currently offer, so they opt to commute outside the city. So we look at migration and commuting trends, we looked at economic trends to get a better understanding of what's happening in the city. And we noticed that in the market share, just to be very brief, there's a $34 million disparity in rental income, right, in the city, and then $220 million of a disparity in the county. And what that means is, an affordable unit is generally 30% of your average income. So if you make $3,000 a month, you typically can afford $1,000 a month, right? So that's how the affordability metric is made based on the $314 million of the aggregate household income in the city of Johnstown. People are only paying about 16% for their residential units, where they have the ability to pay 30%, which would be $94 million. They're currently paying about 16%, which is closer to $60 million. And we believe in our theory that that's a direct correlation in the quality of the unit in the marketplace, because people are only going to pay what they believe something is worth, right? So there's an ability to increase the current capacity of spending by providing a better quality product in the marketplace. And then there's a huge appetite to migrate back to the city due to convenience. The county presented an employer survey that shows a 17% willingness to commute back to the city to live. And that data set ranges at about 1,417 households that qualify to spend more, that have an appetite to move back to the city of Johnstown. If Tania and Sean add the email addresses of people who participated, we can add you to this document. You can take some time to look through our quick pro forma, which shows the assets that we have, where they're located, how many units, the gross scheduled income monthly, the net operating income annually, and then the return on investment based on our current development cost. So, I want to take the last 10 minutes or so to open it up for questions. We're currently in the process of raising $10 million. We own about over 70,000 square feet of mixed use and commercial real estate in the city of Johnstown, actually downtown right now. So We're raising $10 million. We own these properties now free and clear, and we're using monies to acquire new assets and then complete the development of the current assets that we have. So I'll stop the share there, and for anyone who has questions, comments, concerns about any of the things that we just discussed happening in Johnstown, or the fix and flip, buy and hold, wholesaling, any of those things.
First of all, Laquan and Satiir, we just wanted to really thank you for your very thorough presentation, very, very thorough. So in Toastmasters style, Toastmaster Alton, I'd like us to all unmute and just clap. We're really grateful. Let's just clap to show our gratitude. Thank you. Thanks for coming back. Yes, and really blessing us. Thank you so much. 2 questions. One would be, what is the minimum amount of investment could you make as a passive investor? And question number 2, if you are an international investor, so let's say you're in Trinidad or you're in St. Lucia, how can you make an investment in the US? Is that possible? Thank you.
Sure. So yes, to answer your second question, it is possible to invest internationally. I would check with, because of, capital gains and taxes and such, I check with, your local municipality on, how those things work, right? We are a qualified opportunity zone fund, so that's investors nationally, internationally. If you have recognized capital gains through the sale of stock, businesses, assets, you can then roll those dollars over into a qualified opportunity zone fund or business, and then defer your taxes up until 2026. And then it reduces your tax basis based on your hold period. And then any monies made in a qualified opportunity zone fund or opportunity zone in the U.S. is completely taxable. So if you invest, $10,000, you take that $10,000 and make an additional $10,000. The second $10,000 will be completely tax-free. You wouldn't have to pay any capital gains. So the short answer to the second question is yes, you can. The minimum investment for your first question, for our fund, there is a minimum of about $10,000, but it really varies on the market that you're in, right? So if you're in Manhattan, your ability to invest, you may need to participate, anywhere from 10 to 15% of $1 million, right? So you need a little bit more capital. For smaller markets like New Jersey or Newark, New Jersey, Jersey City, Baltimore's, Philadelphia's, the barrier of entry may be a bit lower. So that can really range from anywhere from 5,000 up to X.
I heard you saying something about, I think it was called a house line of credit, where I think I got the idea where you don't necessarily have to have liquid cash. Did I get that right in terms of your investments?
Yeah, so there's a tool, a financial tool called a HELOC. So it's home equity line of credit. And you can actually reach out to your mortgage company. And if you have a certain amount of equity built into your home, you can, instead of selling your home to get that equity or refinancing your home and start your payment process over again, you can take a line of credit against the equity that you have built into your home. And then you can use that money to renovate your home. You can use that money for investment opportunities and such.
Yeah. Oh, wow. Okay, thank you.
Yeah, so real estate is a major pillar of wealth, right?
Yeah, it's very dynamic. Yep.
It's crucial, right? So, my recommendation is, in whatever capacity, I urge you all to participate in real estate investment, because things like a HELOC, right? There's an old proverb in real estate, right? They're not making more land. right? Like they just can't. So, as the dollar begins to depreciate, and it happens at a rate of about 2% every year, property value at different commodities, right? Real estate, gold, oil, etc., they appreciate organically over time. So homes valued $100,000 now will be valued, or the value will increase over time organically, right? There are different market indicators that can force appreciation. You can do construction force appreciation, but property appreciates organically. So if you hold on to your home for 30 years, you'll have a bit of equity built in, and then you can use that equity to make more investments through HELOCs, through refinancing, through the sale of the home.
And you definitely want to pay attention to the opportunity cost if you're looking to invest, right? So if I'm taking $70,000 out of my home and it's increasing my mortgage by maybe $500, you want to make sure that investment that you're investing in, zeroes out that $500 and essentially provides you a cash flow on that opportunity.
Wow. Thank you, Satiir.
Oh, anybody else want to speak up, say anything?
Sure. I think we got a question. In the soft market, how do you go about pricing? How do you notice the shift before it's too late? So, in a soft market, right, we just are a bit more conservative in our evaluation numbers, right? So where we would typically have, so in if you're looking in as it relates to the rental portfolio, right, most investors do a 40 to 50% expense margin, right? We go a bit more at 60, maybe even 70 when evaluating deals in order to line it with cushion so that we build ourselves an exit strategy, right? So we just plan a bit more conservatively in our numbers. And as it relates to noticing the trends, those are the same way you notice the trend upward. It's almost mirrored downward, right? So when you start to see population decline, when you start to see job decline, right? When you start to see businesses, kind of shut their doors, you start to see more vacancy, you start to see more dilapidation. Over time, you start noticing that shift. Off the top of my head, I can't think of a market that's on the decline now. I know COVID has accelerated a lot of migration trends. So, and actually that's a good point. So in Manhattan, right, I think the number is upwards 75% of leases did not renew, right? So, if you're looking at things like COVID, right, that are, scaring people and they don't want to be in densely populated areas, right? That might be a major indicator to say, hey, you know what? I'm not going to pay, $2.5 million for this brownstone here, right? Because you're starting to see people migrate to these tertiary markets and keeping their job in Manhattan because they're able to work virtually or hybrid, right? So they're starting to say, hey, you know what? I can now work from home. I'm going to, my lease is up, and it may make more sense for me to go to a less densely populated area.
Yeah, and just to add on what Laquan was saying is, typically in the soft market, there's really not a lot of equity growth, right? The rents are, basically undervalued as far as compared to the regions. So you'll take a market like ours, which is, a soft market, right? In Pittsburgh, the average rent is about $1,300. And then an hour outside where we are, the average rent is anywhere between $500 to $600, right? That's a major disparity in rent in an area that's like an hour away from each other. So for us, it's just, we're going to get higher cash flows essentially, right? And, what Laquan was saying is just, typically we'll give ourselves a higher cushion due to us, maybe being in a market that's going to have higher turnover because it may be higher crime, things of that nature. There may be other indicators that we can't, necessarily predict. which causes us to add extra contingency dollars to make sure our money's protected, right?
Yeah, and that even goes to when evaluating like kind of renovations, right? So we noticed the market that we're in, homes are a bit older, right? Homes are, I think 48% were built prior to 1970, 40% was built prior to 1940, right? So
88% of the homes was built before 1970.
Yeah, so we noticed that renovation is going to be a bit different. So our contingency budgets have to be a bit higher, right? Because if I'm renovating a home that's built, in 2001, 2002, I know that it's up to today's code, right? So there's a lot more sheetrock. The studs are built a certain way, electrical's roughed in a certain way, plumbing's roughed in a certain way. I know what to expect when opening walls, right? In older homes, in certain markets, they were built to a different code, to a very dated code. So when I open the walls, I may have to redo the entire electrical system because it may be knob and tube wiring, right?
Yeah.
Which if we expose, it has to be ripped out and done to today's code. So we do higher contingencies in those markets as it relates to construction, as it relates to vacancy, as it relates to maintenance, CapEx, etc.
Got it. We have a question from Auntie Mo.
Yes. Hi. Are you hearing me?
Yeah.
Yes.
Okay, great. I wanted to know, how is capital gains calculated? Now, I have a property that I purchased in South Florida about 28 years ago. I paid about $72,000 for it. It's now been estimated value of about $365,000, could be more, because the prices are really going up. And it's always been a rental property. I gave my last tenant, who I had for about 14 years, notice back in January because I needed to upgrade the property. And so he left, and I've been upgrading it for the last 6 months. Now I'm very reluctant to rent again because of the moratorium, where tenants could come and pay for 2 months and then say, well, I have no money and you can't evict them.
Yeah.
I've reached a point in my life too where I don't want the burden of being a landowner.
For sure.
Thinking of downgrading, maybe selling the property and buying a 55+ condo co-op. How would that affect my capital gains if I were to invest in a smaller unit or downgrade my real estate?
Sure. So, there are a ton of different factors, right? So the rule of thumb when selling property, right, if you keep the cash, I think it's just an average of about 27%. But it depends on how you purchase the property, right? So, just helping you specifically, you purchased the property through a business, through you personally, was it an FHA loan? It wasn't, when you purchased the property initially through if you purchased it through FHA, it wasn't owner occupied, was it?
No, it has never been owner occupied. We purchased it, my husband and I, as an investment property.
Okay, as an investment property. Okay, because there's certain incentives. If you initially purchased it owner occupied and then you sell it, you have up until, I believe, if you occupy the property for at least 5 years and then you sell it, I think up to $500,000 doesn't have to be taxed, right? So it's very situational. If you bought it as an investment property, the rule of thumb is that unless you 1031 exchange that money and roll it into a new asset, you would have to pay 27, the average is about 27% in capital gains tax. So let's say, you purchased that property for 70, I believe you said 73,000, you're going out a bit.
So that would be like short term. So if because you had the property longer than a year, it's now considered a long-term investment, and then you'll be taxed if you make anywhere between $40,000 to $440,000, I believe, you'll be taxed 15%. Anything higher.
I'm retired. I am on Social Security.
Sure.
Say it again.
I am retired. I am not working.
Okay, and then if And if you sell it for any more than if you have a capital gains of anywhere between 440,000 or more, it'll be 20%. You kept the property for a long time. You said about 20 years, right?
28.
Yeah, so it'll be considered a long-term capital gain, which would be around 15%. And what Laquan was about to allude to was that you can 1031 exchange to defer your taxes, right? If you want to invest in a property, once you'll have about 6 months, and they've extended it because of COVID, but you'll have about 6 months to defer your capital gains into another project. Right, so they're trying to encourage people to build more houses, and that's essentially how it goes. They'll give you a time frame where you can once you sell your property, you have a time frame from that time frame to transfer the capital that you gained into another property.
Yeah.
Okay.
So
does it matter if the property is of a lesser value than what you're selling?
Yes, because of course. So if you, let's say, for example, you sold that property at $300,000, there is a $200,000 capital gains, right?
Yeah.
Right. Then the condo you want to buy is $100,000. You 1031 exchange and roll that $100,000. That property, that money is deferred until you sell that property, right? So the $100,000 that's left over when you're over, you'd have to pay capital gains tax on, right? You can choose to invest it into, just to defer your taxes. You can choose to invest that money, or you can take the capital gains hit on that particular portion. I'm not an accountant. I'm not a certified 1031 exchange expert. I recommend that you always find professional advice when evaluating those things. But, just from an investor, myself, and a fund operator, I think that, it really falls in the numbers, and it really depends on your personal situation. If you don't need the cash and you're going to allow it to accrue, maybe spend a little bit extra on your condo, right? Or maybe do some renovations, or maybe, it really just depends on your personal preference. And that's a conversation I think is better suited when you have a financial professional looking through, how much you actually spent over time. So you purchased it for 70 some odd thousand, you put work into it. Maybe you have a recognized capital gains of less than, you initially anticipated. So,
in the last 6 months, I have put in another 60,000 in the renovation.
60,000?
Yeah, because we had to almost gut the inside and retile the whole place, redo bathrooms, kitchen, upgrade the kitchen. So, and I would have received all of that.
How's your how successful have you been at renting it out for the last 20 years? Pretty successful, right?
Yeah, yes.
Definitely.
And I can get it rented in 24 hours or sold in 24 hours at this point.
I would imagine if you put that much renovation into the property, it must be a really beautiful asset. So, my recommendation, it just really, there's no kind of cookie cutter answer, right? It all heavily depends on your financial situation and your objective. So, whatever money is not rolled over through 1031 exchanged or deducted through your initial capital investment, it will be subject to tax. A good vehicle is then to say, hey, you know what? I don't need the cash. I don't want to pay this 27% tax. Maybe I'll buy another property. Maybe you can defer it into, another vehicle, right? So that it really depends on your personal objective.
Pardon me. Is that something that Matthew or one of the reps at Fortis Lux could actually help her with and be more specific?
Absolutely. Yeah. So I think it's a combination through the wealth advisement and accounting, right? So
So if I understand you clearly, if I were to invest in another property, say I buy an apartment for 100,000,
Sure.
If I were to have another 200,000 from the sale, I would be taxed on that. My capital gains tax would be 27%.
So it varies. I said my rule of thumb is just 27%, right? Because I don't know at your specific situation, but it's very specific, right? So when you connect with your accountant, they'll be able to tell you your exact exposure.
Laquan, we actually have an accountant on board, Alton James. Alton,
okay.
Please help us navigate this piece.
Her situation is unique. I would need some more information before I actually say what her taxes would be. So I don't want to. There's a difference with the long term and short term. If she had the property for more than 15 years, definitely it's going to be long term. She's going to pay less taxes.
Yay.
Yeah.
No, for sure. Yeah.
Well, how's it, guys? I love it. All right.
Okay, great. So this is good. Thanks so much.
Does anybody else have?
You're most welcome, Auntie Mo.
Oh yes, for sure. And thank you for engaging in this conversation.
Yes.
Anybody else have any questions or statements or anything to share? One thing that I had on my mind was, I know in the beginning, Laquan, you were speaking about the contact information and you being able to coach people through some of these processes. I was just wondering myself how that would kind of look. I mean, you could take a minute or two to explain it.
The coaching
part, yeah.
Sure. Yeah. No, it's nothing formal, right? So we don't have a coaching or mentor paid program, right? We're developing actively, right? So any time that we can take to answer questions, help people in our community, we do, right? So, if you have a question about a deal that you have, we can help connect you with some of our accountants, legal teams, etc. And maybe they can answer questions more specifically. If there's a specific real estate evaluation question, maybe we can help you answer it. If you're looking for a direction to go into, maybe we can, based on our experiences, kind of point you in that right direction. So it's nothing formal, it's nothing paid. It's just more kind of like an altruistic initiative that we have going on.
Beautiful.
Yeah, respect. Respect, and we know from experience and as well that when you give, you do get, right?
Oh yeah, it's a return. Yeah, for sure.
Sure, and and we wish you continued success.
Yes.
And your project is beautiful. I was doing the research on a lot of that, the information you had posted in your media brochure, and it's awesome.
Yes.
Impressive.
And we just want to add one more piece. So every Thursday at 7 p.m. and I'll send a link you guys' way to share with the group. We do an informational session with an elongated version of our pitch deck. Where we go into more detail about the opportunity. We also do, we started to do quarterly investor trips. So we have a trip on the September 26th, and then we also have a trip October 24th, where we have a luncheon. Obviously, the proper PPE and all that is had. We do temperature checks. We do, the gloves, face masks, etc. We have a social distance luncheon with the senior leadership team of Johnstown. So we have executive directors for almost every department as it relates to development, economics, hospitality, etc. We have a luncheon with them. They talk to you about their experience, mission, vision, value, talk to you about Johnstown, the things that they're working on in their pipeline. We do a tour of our assets. We do a tour of downtown. And we speak to local business owners about their experience, having businesses in the central business district and in downtown in a relationship with the city. So, for people that are interested in investing, interested in learning more, about the opportunity, we do have an informational session. Post the informational session, we have trips that we orchestrate, and just to learn more about development, learn more about the city. And we are currently working on a turnkey opportunity where we have assets that in our portfolio that we'll be developing, renting out, and then selling. So more to come on that.
That's awesome.
That's really awesome, Laquan. Thank you again. That's I like to clap.
For sure.
You guys like to clap? Like to clap? Thank you so much. Thank you so much. And again, Robinson Lloyd, we are your data-focused coaching company. We're working with kids. We're expanding throughout districts, and we have data to support the phenomenal work that we are doing. We have life skills coaching from myself and math coaching from Sean. Every third Saturday, we have our gifted literacy and debt management events. We have October 17th. We have a grad fin because of Raymond Blanks, who asked us about getting rid of that student loan debt. And Matthew was on, and Matthew connected us to the person from grad fin. So we're looking forward to our October event. We need to kick that student debt where it's supposed to be kicked.
All right. We'll be discussing consolidation, refinancing, as well as forgiveness. So all of you in that bucket, let your friends know, because there's a lot of people with student loan debt.
Yes.
I'll be there.
Yeah.
All right. All right. Until next time, guys, stay safe and spread the good news. We have a really beautiful powerhouse taking place, so spread the good news.
Thank you.
You guys have a good night.
Thank you.